Hmm. Okay, so we are now back and we are going to study exchange rate calculations. Uh, are you there? Yeah, you are there,
Yeah,
yes.
yes, sir.
Yeah, so we are going to study exchange rate calculations. We have studied forward and futures rates, so it is very much similar to that, and but still something to learn. Otherwise, I would not have covered this chapter. So one is cross rate calculation and how it is calculated. So cross rate is two currency. So since there are arbitrageurs and foreign exchange market is the most liquid market. So whenever we have to do the cross calculation, it must be arbitrage free. So such as first equation is that one is given Canadian dollar and US dollar. That is the rate given. And then the second rate given is US dollar and Euro and US dollar. That is the price currency is US dollar and base currency is Euro. Now, what would be the Canadian and Euro exchange rate? Simply multiply by that and USD is cancelled and that would give Canadian uh, uh, price per euro. So here is the, let's read it. You know this very well. It is quite simple. Uh, okay, so here let's do this for example from here. Assume the exchange rate for dollar Canada is 1.3020 and the exchange rate for euro dollar is 1.1701. So what does this mean? Dollar Canada means which is the base currency is the dollar because the one which comes first, that is the base currency. So Canada by dollar is 1.30 and times here euro. So euro came first, so euro will be the base currency. So dollar will be the price currency. So dollar cancel and that gives us the exchange rate. Okay, or you can write it also if you want. That there is no need to type. It is like this: Canada by USD is 1.30 and USD by Euro is 1.17. So basically, it is the same equation. This one here, and so this is the equation. This part is very easy. It was not difficult. Yeah. Now, what will happen when there is inverse? Uh, that one is also too easy. Like when you have been given this and you have been given this. So what you will do here? USD is not cancelling.
Oh, so instead of multiplying, we'll divide.
You will divide because it is indirect quote. So this part is too easy for you who are good in mathematics. So let's go down. So the electronic dealing machines used in both the interbank market and bank to client markets often provide this mathematical operation to calculate cross rates automatically.
So,
This
but
rate,
that is required for countries. But mostly if it's like Canadian or US dollars or INR, then you already have direct rates. No, sir.
yes. So it is telling that the trader will calculate for you. Electronic dealing machine and means the trader will calculate for you. You don't have to do that. That is what it is telling. So there is nothing. The only thing is something new is here. Here it is. A research report produced by a dealer includes the following spot rate quotes. Okay, this is the spot rate quote. Now let's see what is the question. Yes. So
And the spot CHF by UR is, sir,
closest to
0.99 into 1.171.
yes. So it will be how much? 0.99 into 1.17 will be 0.15. What is CHF by euro? CHF by euro. This one. So USD.
Sir, C, sir.
C.
1.1584.
Yes, 1584. So C is the correct answer. Hmm. The GBP euro cross rate. GBP by euro. Okay, let me go up. GBP by euro.
So
This, yeah.
that divided. Okay, sir. So 1.17 divided by 1.31 only.
Yes.
Then GBP.
GBP by euro no means the reciprocal of this. So GB euro has to be in the bottom. So euro will be this 1.701 GBP by euro. No, which one is stronger? GBP is 1.31. It is 1.31 and euro is weaker. So yes, 1.7 divided by 1.31. Yes. So
0.891.
0.8920. Yes, is correct. And based on the research report, the euro. Okay, let's see. Based on the research, what is the research report? A research report produced by a dealer includes the following spot rate. Okay, so which one is going to appreciate a spot rate and expected rate? So what is the question? The question is, based on this, the euro is expected to appreciate by how much against the US dollar over the next year. So euro, appreciation of euro against dollar. Okay, so this we need to calculate probably. Euro by US dollar. Oh, it is already given. 1.17 and 1.6119. Okay, so which one is appreciating? Euro is appreciating by how much then? 1.17 divided by 1.161, 161 minus 1. So it will be plus. No, euro is appreciating. Dollar is, this one is dollar. So dollar has depreciated. So what we can do, that how much, what is the euro price now? And what is the, if we divide by this and minus 1, will that work?
That is coming as minus 11.
Minus 11.
No, but that means.
Will this work or not? Let's see. Let's do the mechanism. So how much is USD dollar depreciating? It is depreciating from 1.1701 to 1.69. So let's deduct this and divide it by 1.1 euro. So means what is the price of euro? Euro price is this. How much is euro appreciating? Well, it will be the reciprocal of this. So if we do this 1.1619, how we have done, let's understand this. Dollar is depreciating from 1.17 to 1.1619. Dollar is actually appreciating. No, euro is appreciating because euro is in the bottom and now euro is getting less dollar.
So that means euro is depreciating.
So euro is depreciating. So it will be minus 0.7.
So by 11%.
How much?
Sorry, 1.1%.
0.1%. It should be minus. Euro is depreciating.
Euro is depreciating by.
So it will be minus. Now, which one is the answer? Minus. No,
minus 0.7.
0.7%. A is the answer. A is correct. How did he do that? Yes, 1.16 divided by minus 1.7%. Is there any other question? How much is US dollar expected to appreciate against the British pound? Okay, so let's see. US dollar against British pound. So is there clear? The US dollar and British pound. So yes, pound is depreciating. Okay, so how much will it appreciate? US dollar.
No,
it will deduct this. Yeah, this minus this.
So now the British pound is able to afford only less. That means US dollar has appreciated.
Yes, so that is what is asking, that how much appreciate, what percent?
Oh, okay.
So what we will do, 1.3118 minus 1.3066 divided by 1.3118. Means our equation would be this. Answer
3.9%.
3.9% or 0.39%. Okay, let's see. Answer should be like this 4. It should be here 1.3118.
Sorry, 0.39%.
Now it is correct. 0.39%. No? Okay. Minus 1.3066 divided by 1.3118. You use this formula, no?
Yes, sir.
Okay. So 0.39%. 0.4% plus 0.4%. Okay, correct. Question number 5. Over next year, the Swiss franc is compared with what? Let's see.
British pound, euro, and everything they're asking.
Everything they're asking. Okay. So Swiss franc is US dollar, means it is appreciating. Swiss franc, now US dollar will buy less. Swiss franc means Swiss franc is appreciating against US dollar. And US dollar is appreciating against British pound. So definitely Swiss franc is appreciating against British pound. What about euro? Euro is appreciating. Euro is appreciating. So Swiss franc is likely to appreciate against US dollar and British pound. And what about euro? Okay, let's see. How much is the appreciation? Here Swiss franc appreciation is how much? 0.34 divided by 0.99 means 0.35%. Means, no, it is actually 0.0034 divided by 0.99 means 0.34 divided by 0.99. So it will become 0.35%. Well, okay, let's see. And how much was euro appreciating? We had calculated, no? Euro was 0.4. And this one is, so actually euro is appreciating more than Swiss franc because we had calculated here. Euro based on US dollar appreciate against British pound, euro was here. Now best euro is expected to appreciate by minus. Okay, so it is appreciating against all because euro has depreciated and Swiss franc. So it is actually appreciating against all. Did you see that or no?
Yes,
yeah, you saw that, no? So appreciate.
Oh, so there is only one option correct. So C.
Yeah, only one option is correct. Question number 6.
Based on this research report, which of the following lists the 3 currencies from strongest to weakest? Sir, we just saw now, sir. Next year, this appreciates now, sir, like against all the 3.
All the 3.
Euro appreciates again, or
okay, so euro has depreciated. So dollar has appreciated against euro. List from strongest to weakest. So strongest would be euro was the weakest. So then A should be the answer.
Yes, sir.
Yeah, euro was the weakest, no 0.7, and British was 0.4 only.
Yes, sir.
So euro was A should be correct.
Based on the report, which of the following lists the 3 currencies in order of appreciating the most to appreciating the least?
So most appreciated was Swiss franc. It appreciated against all. And then A is the only correct answer because most appreciated was Swiss franc. Then B.
Sir, but Swiss franc is in the middle in both A and C.
No, but Swiss franc was the strongest, no? Based on the research report, which of the following?
Order of appreciating most to okay, B is the only answer.
B is the only answer. Okay, so this one was easy. Forward rate calculation. You had studied about forward rate commodity prices, equity prices, and bond prices, but here it is exchange rate. So since there are 2 currencies involved, that you will learn the new thing. But there is equally like that. Exactly how to calculate forward prices, Ft is equal to S0 times e to the power RT. That was the simplest one. But then we had convenience yield and this cost of storage. So we used to deduct cost of storage and add convenience yield. E to the, no, cost of storage was, what was that? E to the R was cost. So storage cost would be added and then minus convenience yield. So that way we used to do, but here it is only two currencies. So we will have this inflation differential. So let's see, first of all, how it is expressed. So yesterday we had studied that the convention is to express up to 4 digits after decimal. Means whenever there are exchange rate involved, then the convention in the market is to go up to go up to 4 digits after decimal. But for Japanese yen, it was only 2 digits after decimal because Japanese yen is quite weak. So the definition what we had studied in forward earlier also, that when the forward rate is higher than the spot rate, we say that the currency is trading at a premium, forward premium. And here a forward premium when the forward rate is higher, and when it is opposite, then it will be discount. Means when forward rate is less than a spot rate, it trades at the currency is trading at forward discount. Now, what did I? Okay, so here is the example, and let's do what it digital. So with the example, assume that the spot euro dollar exchange rate is 1.15885. So it is up to 5 digits after decimal. And 1 year forward is 1.19. So this one is higher. So which one is trading at a premium? Okay, now hence the forward rate is trading at a premium to the spot rate. Which one is getting a stronger? Euro, because euro is the base currency. So euro is getting a stronger, or this one is known as forward rate is trading at a premium to the spot rate. Because and the 1 year forward points are, so how much is the point? So this is new thing for you to know, not that you have to remember it. That is the way how it is written. So the 1 year forward points are quoted as 364.7, and that came deducting from this to this. Means 1.19532 minus 1.15885 is equal to 0.03675. And so what are the points? Multiply this by 10,000. And then this became 364.7 points. So whatever the difference comes, the convention is to multiply by 10,000 so that would be represented as points, 364.7 points. So this is just the convention that what, first of all, they go up to 4 or 5 digits after decimal. And since the convention is to go up to 4-digit decimal, so that's why in expressing.
What is the point of calculating this?
Oh, means if you are in the trader, you will know this. The trader will talk, okay, it is trading at premium, how many points?
Okay. It's the basic points that we are seeing earlier.
Yes, the points means how many points, okay, but this will change, it is for 1 year point. For half year, it will be half. For 1 month, it will be 1/12 of that.
Okay.
So that way, it is the convention. There is no economics behind it.
Okay.
It is just how they understand. Means like English language. It is the language.
Sir, is this the thing that varies from one trader to the other?
No, it is a standard. It won't vary. That's why it is the convention or language. Means the trader will ask you how many points premium or how many points discount.
So the brokerage fees only will differ.
Yes, brokerage fees will differ, but this trading, this will remain all over the world.
Okay.
Now here is the another example. So we will solve this. That is how it is expressed. So if you are in the foreign exchange market, you will get this kind of screen on your computer if you are doing foreign exchange trading. So maturity is and a spot, no maturity, zero day. It is 1.15885. When 1 week after 1 week, this is the point that will be added to this. So this will become 1.1589. Yeah, because
Sir,
this will be,
so this plus 5.6, is it already determined by them or?
yeah, it is already determined by them.
Oh, okay, sir.
And how it is determined, we will study later in
Okay,
this chapter itself.
okay, okay.
After 1 month, this month, we had said that it
Sir,
should
so basically, as the time increases, the
very good.
spread increases.
The spread increases or the points increase. Very good. You got it. So as the time increases, you saw that. Or when, okay. Or the second thing is when inflation rate or interest rate between the two countries widens, this will
Guidance,
increase.
this will increase. Okay, okay,
Yeah.
okay.
Okay. So you will know that later on here. So 3 month forward rate is okay. Nothing means it was 364. So 3 months, 1/4 of that. And here the convention is 360 and 30, the bond convention. So in foreign exchange market also, the year is for 360 days and month is exactly 30 days. Now here is the example one. Oh, it is the same example that 3 month forward rate is how much more? 80.9. So what will be the forward rate 3 months? 1.588 plus 80.9. So this will be the forward rate after 3 months. So a spot rate is this, forward rate after 3 months. So that's how this is the convention. Too easy, nothing very difficult or so. This one is the way of writing. Now, some people write in percentage, and that percentage is just if
Oh, you
divided
have to
by,
convert it. Okay, okay.
that will be converted into percentage. Since it has been multiplied by 1,000, and so
Sir,
convert,
can you scroll up 1 second, sir?
yeah, where do you want? Yeah,
This 10,000 is
10,000 we multiply, not to get the point. Since they are doing this, they give this for 5. Here is 5 digits, no? After decimal. So if you
oh,
multiply by 10,000, then it will give you the absolute points.
okay, sir. Okay.
Mm. Now, arbitrage lesson we have seen that buy and sell if swap financing. So we now come to the forward rate. How this forward rate is determined, and it is based on swap financing. And swap financing, it is the name, and it is arbitrage free financing. So let's read here. So we have two alternative investment, both. Okay, how this arbitrage works? No, it is this how this forward rate is determined that I want to discuss. But this one is arbitrage. Okay, it is just an explanation that whenever there is mismatch in the inflation differential, let's go down. Let's go down. Then we will come back. This one is very easy. So how this forward rate is determined, and then I will come back if it need be. That this one is the domestic rate of inflation, but where is that part? Let me see. Arbitrage, swap financing. Bearing in mind that the currency quoting convention is the number of foreign currency quotes. This formula is that how to get this risk-free rate of return. So 1 plus RD is the domestic rate. Okay. So what is swap? Well, you will learn this again with example. Let me go down. It is explaining and it is not making, well, unless we have numerical example, remembering these formulas is useless. Okay, yeah, here comes the numerical example and how we derived it. So whenever we did calculate forward rate, so there are two rates, domestic rate and foreign rate. So we had studied that forward price is equal to, let's study by that only, that ft was equal to S0 times times e to the power RT. That is what we had studied. E to the power, or what to do that? Times 1 plus R to the power T. 1 plus R to the power T. That is what we used to study in the simplest forward formula. You remember this?
Yes, sir. The
Yeah, I
simple
remember
formula.
this.
Sir.
Okay.
Yes, sir.
Now here are two rates. So one will be forward rate, since 1 plus R, one will be D. RD is the domestic rate. Now which one to have up? So here, this was the forward formula. Now we have to calculate the currency rate. So for currency, we will have S D by F. So F D by F, D by F, because here are two is equal to S D by F, D by F times. Which one will be on the top and which one will be on the bottom, and why? That is what we need to do. So it will be actually 1 plus RF divided by 1 plus RD. 1 plus RD. That will give times T, and times T to the power T, or times T to the power T. That is what will be the relationship between the two. So if we rearrange this, then what will be 1 plus RD? So 1 plus RD is equal to, now here the T is 1. So let's, for simplicity, if we are taking it to the power 1, means if T is equal to 1 here, or putting T is equal to 1, then what will happen? So if I remove this T, T is equal to 1, then what will happen? This one. So this one is the equation. So we have to find 1 plus RD. So 1 plus RD is equal to, if this will become 1 by SD and times 1 plus RF. FD T divided by SD. And so if you are reorganizing, then are you going to get this? Do you see this or no?
So, but if this FD
1 plus RD came here, and
will
FD by
the
F will be down.
so the FD by F and
FD by
SD by
F is the same. FD by F, yeah.
sir, is the FD by F and SD by F not the same thing, sir?
No, SD by F and FD by F, it is the same thing, but
Sir, so will they not get cancelled, sir?
it is FD is a future price and SD is a current price, so they will not get cancelled, no?
Oh, future.
So
Sir, but then why?
D by F is the naming convention. This is domestic and foreign. Domestic and foreign.
Oh, domestic and foreign. Okay.
So if I bring this 1 by RD here, or okay, so
okay. So we have to see 1 plus RT is T by F into 1.
yeah, 1 plus RD is equal to FD by F.
Oh, yeah, sir. When you sir, if you rearrange it, it will be. Sir, is the 1 plus RT in the denominator or numerator, sir?
Here it is
On the right side.
On the right side is in the numerator, because 1 plus, okay, so let me write it like this. So I will put it here, big bracket, this one. And it is this one. Okay, because I am using S0 times 1 plus R to the power T. So S0 times 1 plus RF by RD, because there are two currencies. And
so if we rearrange it to 1 plus RD, we will go to the LHS and then SD by F divided by FD by F into 1 plus RF, sir. Sir, so no, sir, it's not coming as the same format, sir, because
it is not coming in the same format. Okay, let me do this.
Sir, because only one thing is changing, sir. It is because the
it should come.
SD by F is in the denominator, and but in your equation SD by F is in the numerator.
It is in the numerator times 1 plus RF. Okay, so let's do this. Let me bring this. What is happening? FD by F. So if I bring it here, so 1 plus RD
divided by 1 plus RF
divided by 1 plus RF and
into
times
SD by F.
into SDF. Yeah.
Yes, sir.
So
Yes, sir. We have seen this, no, sir. Like the CPA, WPA calculation and all. So
yeah,
it's spot
well,
rate
it is
SD
here
by F
now.
into 1 plus RD by 1 plus RF. No,
Yes.
Sir, so
So
it is 1 plus RD by 1 plus RF, sir, not RF by RT in your formula, sir.
okay, so it should be 1 plus RD.
D
Okay,
by
because it is D by F. So
RD
it
by
should be
RT.
RD. Oh, yeah, divided by RF, yes. Now it is
Because it's
coming.
already in D by F, and so opposite we should.
Now it is coming.
Now
Yeah,
it
D
will
by
come.
F,
Now
it
it will
will be opposite, yes. It will be opposite 1 plus RD.
come.
So forward rate here it is the summary can be rearranged as it requires that F. Here it is F by D, not D by F. Here it is F. It is F D by F. No, yes. So it is telling that this forward rate. So here it is SF by D. Okay, it is indirect. And then 1 plus RF is above and 1 plus RD. Yeah, it is the same opposite. Okay, so that's fine. So this equation is the same. FD by F is equal to SD by F times 1 plus RD by 1 plus RF. That is how we calculate the forward rate. So this one is
Sir, this second formula is wrong, no, sir.
No, this one.
Yes, sir. Because
No, here the
S.
F is above.
No, sir.
The F
So
is above. It is indirect. It has changed.
no, sir. So the SF by D into it should be D by F only, no, sir.
Oh no, this one has been opposite. Well, here it is the same formula, but here it has been opposite. F by D and F by D means it is the indirect method of saying.
Oh, okay, sir.
It is just the indirect method of saying. This one is direct method of saying, and this one is indirect method of saying.
Oh, okay.
Means if I reverse this, means D by F, I do it F by D. That is how it is.
Okay.
So let's read the example, numerical example, and then you will understand without bothering for this. Yeah. So the theory is that when the domestic interest rate is higher than the foreign interest rate, means
People
the
will invest in
currency will depreciate. Domestic currency will depreciate. The country whose interest rate is higher, that currency will depreciate as per the forward rate. Yeah.
Sir, if the interest rate is higher, then there will be higher foreign inflow.
No.
That
That is later. If you change it to higher, then there will be inflow. But right now, if interest rate is higher, means there is higher inflation rate. Such as Indian interest rate is higher than US interest rate. Because inflation in India is persistently higher than US inflation. So, yeah. Means if the country, okay, let's do the arbitrage thing after that. Or let's do this example, numerical example. And then we will do the arbitrage. Okay, let's do this here. So given the spot exchange rate and the domestic and foreign risk-free interest rate, the forward rate is the value that completes this equation and eliminates any arbitrage opportunity. For example, let's assume that a spot exchange rate F by D, it is indirect method, is 1.6535. So this one is actually a spot F by D. It is indirect method. It's 1.6535. The domestic 12-month risk-free rate is 3.5%, and the foreign 12-month risk-free rate is 5%. So the risk-free rate in foreign is higher. Means the inflation is higher in the foreign country.
That means the foreign country is depreciating.
Very good. Or domestic country will appreciate. If it is 1 point, okay, so since this one is domestic currency will appreciate, means
it will be able to buy more of
it. Increase, yeah, more of foreign currency. So this will become more than 1.6535. Yeah. So here SFD, because it is given SFD, so 1 plus RF, whatever is here, the opposite interest rate comes up. Means if we are using domestic, then here will be 1 plus RF by 1 plus RD.
Yes, sir. Okay, sir. Okay. Yes, sir.
And if here we were having F below, here it is F below, so we had 1 plus RD in the numerator because it is F below here and 1 plus RD by 1 plus RF. So whichever below the interest rate is opposite of that. Okay, so yes, now here F by D again. Okay. Now, okay, so it wants to calculate that what percentage will it depreciate. So suppose instead that with a spot exchange rate and interest rate unchanged, you were given to quote on a 12-month forward rate is this much, 1.690. We have how much? Here we calculated 1.6775. And in the forward market, it is higher. So what will you do to arbitrage? What will you do? Which one will you sell and which one will you buy?
Sir, can you repeat one thing, sir?
So it is given here that we calculated forward rate to be 1.6775.
Yes, sir.
Yeah. Now it is telling that suppose you are given the forward rate of 1.6900. So 1.6900
is higher than this, so we will short this and buy those high.
Very good. So because this misquoted forward rate doesn't agree with the arbitrage, it would present a riskless arbitrage opportunity.
Sir, but in the real world, such arbitrage exists only for microseconds now.
Yes, that's it.
The high frequency trading spots it and like
and they will do it. Yes. So then it is asking us that what is the arbitrage opportunity. So this can be calculated by using the arbitrage equation to compute the return on two alternative investment strategies. So the return on domestic only investment approach is the domestic risk-free rate. So the domestic risk-free is 3.5% and foreign risk-free rate is 5%. So the return on the hedged foreign investment when this misquoted forward rate is put into arbitrage. So this one was our initial exchange rate. Then 1.5% is the foreign interest rate divided by this forward price. Means it is using this 1 by forward price. And so it is giving 2.073% interest rate or gain. It is nothing great here actually. So since it is 2.375 return, and here the risk-free return is only 3.5%. So there is a gain of, okay, now.
Sir, but what is this?
I'm telling you what this results in a return of 2.73% from arbitrage. So what will happen? The investor would make riskless arbitrage profit by borrowing at the higher foreign risk-free rate. He will borrow at 5% risk-free rate, sell the foreign currency at the spot exchange rate, and hedge the currency exposure, means buying the foreign currency back at the misquoted forward rate. We had said that we would sort forward rate, and that was correct actually what this book is doing. Since this book is calculating differently, so it is telling that, okay, investing the fund at the lower domestic risk rate and thereby getting a profit of 77 basis points, means 3.75 minus 2. Okay, so what does this book want to tell us? Arbitrage profit. We had said that we would short forward and then long the domestic currency, and then we will invest it there, and then again when it matures, then we will get the arbitrage profit.
Yes, sir. Yes, sir. Yes, sir.
Now here it is telling that we will borrow.
Yes, sir, because that is the meaning of arbitrage. Like we don't use our own money.
From where to borrow? Yes. So it is borrowing from the foreign currency where interest rate is higher.
Yes, sir. Okay.
So if it is borrowing from interest rate currency, means it has already shorted the foreign currency. Since it
Yes,
borrowed,
sir.
means it is
Borrowed.
negative. So
Yes,
it
sir.
shorted right now, then invested in domestic currency, and then again hedged it at the forward price of 1.69. And that way it is earning 2.77 basis point higher. That's what it is telling. So this is the another way of earning arbitrage profit. So what happened? If we would not have borrowed, we have simply sorted forward rate. But then the another way is that we are borrowing in the foreign currency, investing in domestic currency, and since forward price is mispriced, so we have already borrowed foreign currency. So we have to pay back in the foreign currency, and that's why then we will have to buy the forward. That is what this book is telling. Though both will give the same result. You short forward right now. So if you short forward right now means
Yes, sir. By shorting the forward right now, you'll get that money and
you will get the money right
calculated.
now. You don't need to borrow then. If you
Yes,
shorted forward means then you need to borrow. You don't need to borrow.
yes, sir.
Because you got the money and invested in domestic currency, and then that will grow, and then again at the maturity you will convert that. You will
Sir, but
return.
you technically cannot short the forward right now unless you own it now, sir.
You cannot. Oh, why can't you? Because you have
With an equity, we can borrow and short it, sir.
shorting is with forward also. You can short the forward.
Okay.
Yeah, you have provided this money, margin money.
Oh, that is the futures now, sir. The margin money is given for futures, not the forwards.
Oh, okay. So you are saying it is forward, it is not future. Okay, so in future you forward you cannot short. Yes.
Yes, sir. Futures we can do, but not in the.
But not with the forward. Yeah, yes. I was.
So that is why he is borrowing, sir.
That's why he's borrowing. Yes.
Because on the 1 year, like after that, when when the forward date is
Yes.
met, that time he can short it instead of he can sell it to the buyer, but he can't sell it right now.
Yes. Yes. Yeah. Yes. It is forward, not future. Yeah, correct. So what is happening? Okay, so the thing is that the final conclusion is it is f by d is equal to sf by d times, since d is bottom, so it will be 1 plus rf by 1 plus rd. So the underlying arbitrage equation is the same thing that we had calculated, arbitrage free equation. Now, so what happens? More generally and regardless of the coding convention, so what is the conclusion? The currency with the higher interest rate will always trade at a discount, means it will depreciate in the forward market. So whichever currency has higher interest rate, that will always trade into discount. Why? Because of this equation. Yeah. So one context in which forward rates are quoted as a percentage of spot rates. So this one was absolute value of forward and absolute value of a spot. What if it is percentage? So FT is equal to ST plus 1. That's what happens, because at the maturity date both must equal. So substituting this means FT is equal to ST plus 1. So FT means if you make it here ST plus 1. So this became ST plus 1 divided by ST, and minus 1 is equal to percentage change in ST plus 1. It is telling that how much will the spot rate after period 1 will change, because it is asking in percentage, and the formula is RF minus RD divided by 1 plus RD, because RD is the base one. Unless we do the numerical, because it doesn't make, you don't have to remember it. If you do the numerically, you will easily understand it.
Sure. So technically, the value of forward and spot will be 0 at inception, like the other cases we had studied now.
The value of forward and spot
at inception would be 0, right?
Yes, exactly. Yes, it is always there. Let's see the question. What is the question? A lot of junk material is written. So the conclusion is it is best to understand forward exchange rate simply as a product of arbitrage equation outlined earlier and forward points as being related to the interest rate differential. That we already discussed. Discount, forward discounts and premiums. Well, let's do this question. It is numerical, and if you do this, because there is no point in remembering these. Let's do it numerically. We will solve ourselves, and then we will understand. Suppose that we wanted to determine 30-day forward exchange rate. Means it is 30 days, not 1 year. Given a 30-day domestic risk-free rate, interest equal to 2%. So RD is equal to 2%. And 30-day foreign risk-free interest rate is 3%. Okay, RF is equal to 3%. And the spot exchange rate is 1.665. SF by D. Okay, so what do we want to? The risk-free assets used in this arbitrage relation are typically bank deposits quoted using the LIBOR for the currencies involved. The day count convention is third actual by 360. So here is 360 days. So we will multiply 30 by 360 as our T. T is equal to 30 by 360. Now, incorporating the fractional period tau and inserting the data into the forward rate equation leads to the following 30-day forward rate. So what will be the forward rate? Let's calculate ourselves. So we have to calculate FT is equal to S0, and we have actually currency. So I will write it D by F. Which one to? Okay, if it is D by F or F by D, we will just take the reciprocal. So F, I used to do this D by F. That is what the convention was for direct. And S0 or S D by F times times since it is F, so we will have 1 plus RD. 1 plus 0.02, that is the RD. 02, sorry, 1 plus 0.02 divided by, okay, I'm writing the formula. So I will write here 1 plus RD divided by 1 plus RF divided by 1 plus RF and times T, times tau. So times, and this one is here, times T. Okay. So this one will be here. This one is very easy to understand, means nothing to worry about. That is what we have been doing for months. Now, what I will do that, I will convert it. So we come down. SD is equal, which is equal to.
Sir, that T
SD.
is.
Yeah. Go ahead.
We didn't have the T there, no, sir.
T is equal to 30, no, 30 days. So 30 by 360. Here it is telling you actual by 360. It is telling
Oh,
you.
okay, sir. Okay. The formula you're using tau as T. Okay.
Yeah, T is equal to 30 days. So 30 by 360. That's what he's asking.
Okay.
So 1 point, we get this here. So it is clear now. And then times. How much is 1 plus RD? 1 plus RD is domestic risk 1.02. So 1.02, and then times T is 1 by 12. Well, I have to divide by 1 plus RF. So I will put that in the end. Times 1 by 12. How much will be 1 by 12? Okay. Times 1 by 12 and whole divided by 1.03. Oh, okay. So why not to do like this? Why even have this? Let it be divided by 1.02 times, no, 1.02 divided by 12 times 12 times 1.0. Is that okay?
Sir, so 1.03 is in the numerator only number.
1.03 RF. RD, no, I am using RD by RF. I am forwarding, I am calculating this. No, so 1.03 is in the denominator because 1 plus RD divided by 1 point RF. And okay,
But
here
T,
is
T should be in
1.03.
the.
It should be in the bracket, into this bracket. Let's put this in the big bracket. But yeah,
Sir, but where is this 12 coming from, sir?
this 12 is T by 30, no? 12 is coming
Sir,
30
so
by 350.
uh,
Okay, let me
oh,
put
okay,
it
okay,
like
okay, sir. Then okay, understood.
okay, let me put it like this. And this divide whole divided by 12. This one is here. Sorry, this divided by 12, and then I close this. Is that okay now?
Yes, sir. Yes.
Okay, so please calculate this part. 1.8.
0.13.
How much?
0.1366.
No, this one is the S0 times 1 plus RD by 1 plus RF. Okay, so how much does this come? 1.02?
0.9998.
0.9998. Okay, so 0.9998. But this one is 30 by 12. It should be power T. So not 1 by 12. So how much is the interest?
So the whole value is 0.1366.
No, that one is wrong. Whole value is equal to how much?
1366.
0.136. This one is wrong definitely because it should be 1.665 and slightly down. Means domestic interest rate is lower. So if it is lower, means it should appreciate. So domestic interest rate is lower.
Sir, so that means the formula we are using is wrong now, sir.
Oh,
Because
the formula, yes, it should, but then it should be F by D. The formula we are using is wrong. The question is, it should be forward
oh,
rate.
no, sir. So we have to just subtract this from 1.6555.
Oh, yeah, now you are correct. So then this one is equal to, so hence FD, okay, yes. So this one will be, we have to subtract from this, yes. So it should be S D by F minus. Yes, now it is correct. So now we have
1.5188.
1.51.
No, sir, not here. Down.
Yes, it will be here. 1.5.
5188.
It still looks a bit wrong to me because so much difference. Okay, let's see the answer. But we should be able to fix it ourselves without looking at the other. Then only we have learned, no? Okay. So 1.5. The thing is that domestic currency would appreciate. And so it is good. Direction is good. The thing is, in 1 month, it should change by 1%. Okay, so in 1 month, it should change by in 1 year, it should change by 1%. And so, looks like correct. Looks correct. Let's see. 1.65. Yes, it was wrong. Okay, let's see where we made the mistake. 1.03. Okay, here was the problem. This one was the problem. Actually, we needed to multiply this 1.655 times 1 plus this. So it is actually
Reverse.
this
Okay, sir.
one is okay. We had done D by F. This one is F by D. So it means we will reverse it. We had done by D by F.
Then we should do 1 by 1.6.
Okay, let me do this. The thing is that this one is only 30%. No, so interest rate is 30%. So 1.1 plus 0.02 divided by 12 because 1 by 30. And then, so this one will be in the parenthesis, 1 plus 0.02 divided by 12. And then again, 1 plus 1 plus 0.03 divided by 12. And this one is in parenthesis because we are doing it for 1 month. Okay. Now, how much will this be? 0.02 by 12 is how much?
One second.
So this one is equal to 1.655 times.
The whole value is
How much? It should be less than that. 1.655. It should be less than that.
1.6541.
Okay, very good. 1.65 is correct. Now, ours is FD by F. Okay. So we will have to calculate F by D. So if we want to calculate reciprocal of this, 1.641 is happened. So, but ours is FD by F. But we have to calculate, if we calculate F by D, okay, so how much did it change? It changed by about 14. So this 14 would be added. Okay, so F by D. F by D, because which one is depreciating? The foreign currency has higher interest rates, so foreign currency is depreciating, will be 1.655 plus 0.0014. Here it was, which is equal to, means you did it like this, no? Which one? This one is write like this, equal to 1.655 minus 0.0014, which is equal to 1.6541. And if we do this S, so F by D, we will add that, and that will become equal to 1.6569. So that is what this all mathematics is. Means when we are calculating FD by F, means domestic currency is appreciating. So this will go down, and it will go down from 1.655 to 1.6541. And when we are when we are calculating the F forward, F by D, then that will be added. Okay, now tell me one thing. Looks like I didn't explain very well, or because I am myself not very satisfied that I could tell you what I wanted to tell, or what? Did you understand this or no?
Sir, no, sir.
No, sir.
Because how will the question actually be framed for this, sir? I don't understand.
Oh, the question. Let me see if there is any question. That was the question. So here is another thing, means the way it was added. Okay, let me see if we are on page 271. Let me see if there is any question. And we will show example. Why not to solve this? Why not to solve this example?
Okay. Yes, sir. A French company recently finalized a sale of goods to a UK-based client and expects to receive a payment of 50 million British pound in 32 days. The corporate treasurer at the French company wants to hedge that risk and receive the following exchange rate information from the dealer. GBP per euro spot rate is 0.8752. 1 month forward points is minus 1.4. So that means euro is appreciated.
Yeah, euro is appreciating. Yes, you are correct. Euro is appreciating.
Appreciating, yes, sir. So according to the exchange rate information, the treasurer could hedge the risk by
yes.
buying euro at a forward rate of 0.873, buying euro at a forward rate of selling euro. No, sir, because it is expected to appreciate, then he has to buy the euro. the forward rate is.
So you will add this 0.8752 times, multiply this by, it has been multiplied by 10,000. So divide it by 10,000 and add into this. Because yeah, so divide it by 10,000, that will be 0.00014. So one of these two, either this or this, means the answer will be either B or C. Either B or C, because this part is correct. Forward price is correct. Now the question is, which one will be correct? The corporate treasurer at French company wants to hedge, no, so he will buy forward, buy euro at a forward rate of 0.8750. So he will buy forward because he wants to hedge. So on that day, he will get this price. So B should be the correct answer. Now, is this clear to you? First of all, I don't know if answer is correct or not.
Sir, buying the euro is definitely the.
Yeah, so if you know that buying the euro forward is the
forward rate would be the 1 month forward point. You have to divide it that by 10,000 and then add it with the spot rate. That is coming out to 87506. So B is the only correct answer.
B is the only answer. Yes.
According to the exchange rate information, the best interpretation of the forward discount is that the euro is expected to depreciate over the euro is expected to appreciate. The 1 month UK interest rates are higher than those in eurozone. Yes, sir, because that means.
Yeah. So B is the correct. But 1 month euro interest rates are higher than those of the okay. Euro has depreciated, no? Here,
euro has appreciated.
Euro has depreciated. Euro, it was it is minus 0.14, no?
No, sir. Then.
Yeah, so euro has depreciated. No, means you are receiving less GBP. Right now you are receiving 0.8752 GBP.
Okay,
After a month you are receiving less GBP. 87506 only, not 52, but rather 50. So euro has depreciated. And if euro has depreciated, means interest rate in euro is higher.
So then selling the euro is the correct option, no, sir? Why would we buy the euro?
Buying is the euro is the correct option because he wants to hedge. Right now he doesn't know. He doesn't know how much it will depreciate. Means here it is expected, but will that actually happen? In hedging, you buy the forward rate, no? Whenever you hedge,
but here, like you buy a call option anticipating an increase in price. But here, the expectation that the price will decrease. So you will buy a put option only. Why?
No. He's not making money by that way. He's hedging his risk because he has to hedge his 50 million. No, here he is hedging this 50 million. That this 50 million, how much will he receive euro that way?
Okay, sir. Okay.
He's not speculating. Here he is hedging his 50 million. So he wants to be sure that he will receive that money.
Okay, so sure shot he needs to get the 50 million British pounds.
Yes.
So
and then he wants to send it to euro.
Yes, sir. So
what if euro depreciates more? The corporate treasurer is a French company.
Okay, sir. Then he will not get 50 million. He will get less than 50 million.
He will get less than 50 million. Yes.
Okay.
So that's why he's buying the future. So buying the future is for hedging or forward. Buying the forward is for hedging, not for speculation.
Okay.
Yeah. So the interest rate in eurozone is higher. We shall know that whichever has higher interest rate, that currency depreciates. Since euro has depreciated, means interest rate in euro is higher.
Yes, sir.
Yeah. Okay. Yeah. Question number 3.
According to the exchange rate information, if the 12-month forward rate is 0.87925 GBP per euro, then the 12-month forward points are closest to. I have to subtract both the
Points, yes.
points.
So 87295, and how much was it in the beginning? And multiply that by 10,000. Uh, 8752. So 8752, and how much was that after deduction? Question number 3. According to the exchange rate, if the 12-month
minus
forward,
22.5.
yeah, 87295. It is
Eight,
87,
eight,
yeah,
eight.
87295. Okay. So minus 87295, let me type it. And then multiply it by 10,000, yeah?
Yes, sir.
87295. How much does it come? This one is equal to mm, mm,
Sir, after
87
multiplying by 10,000, it is minus 22.5.
minus 22.5. Okay. So which is equal to, and then times 10,000. Times 10,000. So I will put, oh, sorry, this one will be here, and I will put a bracket here, this bracket here, and that way we get the answer to 4. So this one is equal to how much? Minus 22.57. Whatever it was, minus 22 something. Okay. Minus 22.5. Okay, is correct.
Yes, sir.
Question 4.
If a second dealer quotes GBP per euro at a 12-month forward discount of 0.30% on the same spot rate, the French company would.
Okay, so is this 0.30? Means if we found 0.225 divided by 0.87, how much was that? 8752. So is it 0.30%? Means 22.5 divided by 8752, and calculate it as percentage. I think it would be equal.
25.7%.
Huh? How
That is
much
coming
is
out to
it?
25.7.
25 divided by 87, no? So it is
No,
only,
sir. 22.5 divided by 0.87520. It is coming out to
yeah.
be 25.7.
Okay, 25.7, and this guy is giving 30% discount. So he will go for the other one. The lock in a profit in 12 months so A is definitely not the correct answer.
Yes, sir. So we have to buy from the second dealer and sell to the original dealer.
Yes, because he is selling, he is giving forward cheaper,
Yes, sir.
30% discount.
30% discount. First guy is giving 22.
0.25, yeah, 20 means 0.25%. If you calculate in percentage,
Yes,
then
sir.
that is 25%.
0.25. Yes, sir. So by
So who is giving more?
second
Because
guy is giving.
second guy is giving more. I mean, the one who is giving more, you need to sell that. And well, you need
Oh, no,
to
sir.
buy,
You
you
buy
need to
that,
buy
sir.
that.
Buy low,
You
sell
need to
high.
buy that because you are going to get more from him. So lock in a profit at 12 months by buying euros from the second dealer. By buying euros from the second dealer and selling it to the original dealer. Lock in profit by buying euros from the original dealer and selling it to the second dealer. Okay, so who is giving more discount? From them we will buy. So second dealer is giving more discount. So buying euros from the second dealer, which is cheaper, we buy that and sell to the expensive one. So B should be the answer. Do you agree, or what do
No,
you
is
think?
that B the answer?
B is the answer, no? Yeah. Question number 5.
If the 270-day labor rates for the euro and British pound are 1.37 and 1.325 respectively, and the spot rate is 0.8489, and the number of forward points for a 270-day forward rate is closest to 2.
Okay, let's calculate this
Yes,
here only.
yes, sir.
Yeah, we will use this formula. So, what is the interest rate? 30-day LIBOR rate for the euro and British pound are 1.370. So 1.370. Yeah, we will have this 1 plus, but then 1 plus. So which one? Okay, this one is euro. 1 plus, and this times 370 by 260. So
No, sir. 270 by 360, no, sir.
270 by 360, yeah. So 0.75
Yes, sir.
times 0.75. Okay, this one is euro. And what is the British interest rate? 1.325. This divided by within parenthesis 1 plus, and again parenthesis 1.325. So 1.325 times 0.75 times 0.75. So how much does this come?
Sir, the whole value comes out to be 1.0003.
Very good. So 1 point, which is equal to 1.0003. Okay,
Yes, sir.
that is what it comes. So
that
euro
times
will
the
depreciate.
spot rate.
Yeah, so euro will depreciate. That's for sure. Now we multiply this into 1.003. No, so
Into 0.8489.
yes, times 0. And then multiply by 10,000. Yes. So this times 0.8489, which is equal to how much?
So then divide by 10,000, sir.
Divided by, multiply by 10,000. 1 point divided by 10,000.
No, sir. If I multiply by 10,000, it is 85,000.
The difference means means that is the difference. 0.003 times 10,000. So if you multiply this, it will be less than 22.8. Yeah, minus 22.8 would be the answer. It would be the answer. Because this one is okay. Multiply this 0.003 times 84 and then multiply by 10,000. So if I multiply this by 10,000, means this becomes 3. Okay, and then times 10,000. Okay, this is the answer. And that will, and this one is minus actually, because
2.54, sir.
2.54, that's it.
Yes,
0.00, oh, then 2.4, then it's minus 2.8. Yes, C. Okay.
Euro and British pound is 1.3 and 1.325. In the spot rate is GBP per euro. So 1 plus euro by 1 plus British, okay, so 0.370 22.
So that comes out to be 1.003, but then
Yes,
direct minus 1 because 1 is the common.
the whole value minus 1. Okay, okay, sir.
Yes. So
But,
0.003 multiplied is 3. 3 times point, yeah, you are correct. 2.8 is the correct answer. Minus.
sir, but how is it depreciating, sir? That's my question, sir.
Which one is depreciating? Euro is depreciating, no?
Euro and
the spot
euro
GBP
has
by
highest
euro
rate.
exchange rate is point. Then the number of forward point for a 270 point. Yeah, it will be minus 0.2x.
By euro. So euro interest rates are increasing. So euro is okay, sir. Then euro is depreciating. Okay,
Euro
sir.
is depreciating.
By
Now
2.8.
the question is, how many points? So yeah, this looks like correct. C. Let me see. What is the correct? Either C or A, but it is a matter of 0. How much does this come? 2.8 or 2.28? 2.22. How much does this come?
I'm going 2.54, sir.
2.5, what is in between? So C. C is correct. Okay, good. So this kind of, so did you have any difficulty in solving? Practically no, because we
No,
answered
sir.
it was not. So you basically understood. Okay, let's go down. 0.0028. Yeah, the book has calculated and then it gave this.
Sir, but then why are they? Sir, can you scroll up one second?
Yes.
Sir, why are they putting it into? No, sir. Solution only.
Solution. Okay, let me put it. Where are they putting it? Yes.
Sir, in the solution, like, why are they taking the power of 270 by 360 and also?
Is it power?
Yes, sir.
Well, we have to the power t, no? Whenever we calculate forward, since it is 0.75 and this one is to the power t, it will be to the power t. This shows the forward point, and this can also be seen using the stop point. So this is the another formula. That's it.
Oh, no, sir, no, sir. The thing is, like, we didn't subtract it, no, sir.
What?
We got 0.84862, same using our method.
Hmm.
Then we have to subtract it from the original points, right? So then we will get.
Yeah. So I subtracted one, no, because it was
Yeah, instead of
1.2
one, we have
actually.
to. Yes, sir. Like, instead of one, we have, if we subtracted like 0.8489, then we would have got the exact answer.
Okay, so the calculation minus 3.8 point. Okay. Oh, so but the answer is B, no? I think the answer. What was the answer? The
Answer is
answer
C,
was
sir. C, C.
C, yeah, and we calculated C only, no?
No, sir. I'm
B,
just saying.
yeah.
We got
We
this
had
value,
calculated
sir.
C.
Yes, sir.
Minus 2.8, I had said, no?
Yes, sir, sir. I'm just saying,
Yeah,
like.
but if you would have taken power, then it would have been this what exact point 2.8. Is that you are saying?
No, sir. I'm just saying.
Hmm.
This value we need to subtract it from 0.8489
Yes.
to get minus 2.8.
Uh,
Exact value, I'm saying.
but we already calculate directly, no? So you are saying that actually, how much does this come? This comes to be exactly minus 0.2.5, no?
Yes,
Means,
sir, that comes to be 2.545, sir.
yeah, 2 point, this is equal to 2.5 minus, this is equal to minus 2.54. Okay. So, which is equal to minus 2. But if you would have taken power, instead of multiplying this, if we would have taken this as power, because it is power t to the power t, no? So if we could have taken this, and here also.
No, this formula is confusing, sir. We'll leave it.
Hmm?
We'll leave it, sir. We'll go with the old formula, sir. This
Okay,
power is confusing.
power is no need. Okay, so times. Okay, then we will get approximate answer, but we will get the close to
Okay,
approximate
sir.
answer.
Okay, sir.
Yes. Even if you do power, it will come the same. It is not difficult. But
No,
anyway.
sir. I was just used to this. This is better.
Oh, you are used to this formula without power. Because you do e to the power RT. In that case, you are doing continuously. If you are doing discrete, then it is just multiplying.
Yes, sir.
Okay. Now, only two questions. That's it. No, there are more questions. Only part one for 1 and 2. Okay. Please.
The spot ZAR by HKD is okay. Then ZAR by HKD
Cross rate.
0.8422 divided by 0.9149.
Okay. Jar. What did you say? Point?
8422 divided by 0.9149.
8422 divided or multiplied? Let me see. It is cross rate, no? So jar by HKD. Jar by
Only if we divide ZAR will go on numerator.
jar has to be in the numerator. Yes, it has to be divided. Yes. So jar by HKD. So CNY by HKD. And so this one has to be in the downward. So 0.8422 divided by 0.9149. Yes.
A, sir.
Okay, 9149. Very good. A.
We didn't even need to calculate, sir, because
Yeah, we don't even need it has to be less than that. Yes. All are higher. Question number
Another
2.
dealer is quoting ZAR per SCK cross rate at 1.210. Arbitrage profit that can be earned is closest to.
Okay.
So from here we will.
So here we need to his jar SAK cross rate 1.120. Jar by
So again 1.0218 divided by 0.9149.
so you are saying equal to what?
0218 divided by
1.0128 divided by
0.9149.
0.9149. Okay, so how much does it come? This one is equal to 1.02 1.0218.
1.1168.
It is 0.218. Okay, 1.0218 divided by 1. You wrote this.
No, sir. 1.1168.
1.1168. Okay, and how much is he giving? 1.20. Okay, so arbitrage profit.
Yes, sir.
Arbitrage profit. Okay, AP is equal to 1.002. 1.10 minus 0.2. This is equal to 42. 1.12. What is the 1.1210 minus 1.1168 is equal to how much? 40.42.
It's coming out to be
0.0042.
0.004157.
0.0042
Okay, sir. Right, sir.
per million South African rand. Per
Or
million. So yeah, so if you multiply this by 1 million, so it should be B.
oh no, sir. B or C, sir. Which one, sir? Because I
Okay,
think it's
let
the
me
same
see.
option.
Okay, let me go down. B or C, which one? Let me see this. Point per million Swedish krona. Okay, so sick. Another dealer is happening, is quoting jar by SEK. So
Both are jar by CK.
both are jar by SEK. And we are calling the, so which one is the cross rate? So SEK is, this guy is giving higher exchange rate. So this SEK is per SEK because we are making profit per SEK. Actual profit is this much, actual price is this much, and so per SEK. So we are calculating, we are making jar per million Swedish krona. So SEK is the base currency. So this one is, well, this is not rand. We are dealing with a jar now. So jar by SEK. So C is the correct answer. Do you see or do you understand or no?
Jar and Swedish Corona. Oh, okay, sir. Then only C is the.
Only C is the correct answer.
Oh,
Yes.
okay, okay. B is not the.
No South African rand.
Rand. Okay,
Trying
okay.
to confuse.
Okay, okay, okay.
Okay, question number 3.
Brazilian per Mexican spot rate is listed as 0.1378. 6-month forward rate is 0.14193. 6-month forward points are closest to.
So we will deduct this
forward
and
minus
multiply
C
by
spot.
10,000.
So forward is 0.14193 minus 0.1378.
Yes.
10,000. 41.3 positive.
B.
3-month forward exchange rate is listed by a dealer at 1.0123. Dealer also quotes 3-month forward points as a percentage of 6.8%. The spot rate is closest to.
Okay. The spot rate is closest to no. So 1.0123, and this we will add this. So the spot rate. Deduct this. 3-month forward exchange rate is this much, and the forward point is this much. So
then forward minus forward points is spot rate.
Yes, forward minus forward point is the spot rate.
So you'll have to 6.8. Sir,
divided by 10,000.
Sir, or is it 0.068 divided by 10,000, sir?
No, it is point. No, so means it is
Okay.
already multiplied
Already
by
6.8 divided by 10,000. 1.0.
0.01. But what it is?
So it's coming out to be 1.01162.
Yeah, 1.01162, but it's not the option.
Option.
3-month forward.
6 months. Okay.
It is. It is percent.
So that's why I'm asking, sir.
Percent. No, so percent will be then
0.068 divided by 10,000.
Yes. So percent means the dealer also got 3-month forward point as a percentage at yes. So first we will have to calculate the percentage of this and then multiply it by 10,000. No, 100 only. Okay. Let's do it like this way. 6.8% is the decline. So why not to deduct from here simply 6.8%? So A should be the correct answer. Okay, no, it is up. So we will add 6.8%.
Sir, how do we know it's
Add
increasing
this,
or
no?
decreasing, sir?
Huh? It
How
is
do you know?
increased, no, it is positive, no?
Oh, okay.
6.8% is positive. So you will add this 1.0123 plus 0.068. Means our answer will be, since it is percentage, so 1.0123 plus, it is percent, so 0.0, this divided by 100 means 0.068. Now you add this, how much does this come? 1.862, no?
Sir, should it not be 1.0123 into 1 plus 0.068, sir?
If you do that, it will give the same result almost, okay? Means if you can do this also times, it will give almost the same result. Times 1.068.
1.023.
Which is equal to how much? 1.8 should be C.
Sir, it's giving 1.0811.
Okay. So C is the correct answer.
Sir, or if we do it your way, sir, like 1.0.
It will give the same slightly, mine answer will be slightly less. Means I was doing the simple way, but
Sir,
A
this
cannot
one.
be the answer, B cannot be the answer, only C will be the answer. That is what I am telling
Oh,
you.
okay, sir, because it has increased, so only C is the possible answer.
Only C is the
So,
possible
you
answer.
want to
Yeah, B
calculate.
is possible, but this one is less. Okay, then go to 3-month forward point as a percentage at 6.8%. Now this 6.8% 1 year or 2 year? 1 year or only for 3 months. The problem is here. The dealer also forward point as a
Sir,
percent.
everything is quoted in 3 months, sir, so no need to convert.
No need to convert. Okay. Then see. Question number 5.
If the base currency in a forward exchange rate is trading at a forward discount, which of the following statement is most accurate? So if it
So
has a
base
discount,
currency
then
trading at
spot is
discount.
greater than the forward. So
Very
that
good.
means
The spot
forward
is
point is
greater.
negative.
Yes.
Uh,
Will be so B.
no, sir. That forward percentage is not forward points, no, sir.
Same thing. If it is percentage negative, then point will also be negative. They will go in the same direction, no? Means if the percentage is positive, means
Sir, or C is the answer, no, sir. Base currency expected to appreciate
versus the price currency. The base currency, no, the base currency in a forward exchange rate quote is trading at a forward discount. Means base currency is going to depreciate.
Sir, if it is trading at a discount now, then to equalize, then its
The
value
spot
has to
is
increase.
higher. The spot rate is higher than
The forward. Okay, sir. So then it has to depreciate. Okay.
it has to be depreciated. Yes.
Okay. So B is then.
B. Okay. We are tired, rather. Anyway, now this is the last 2 questions. Only 2 questions left. Question number 6.
Forward premium indicates forward is greater than spot price.
So
an expected increase in demand for base currency. Yes, sir. That means it is going to appreciate.
Unexpected, okay, but let's see the other interest rate thing.
Okay. The interest rate is higher in base currency than in price currency. No, sir. No.
If a forward premium indicates, forward premium means the interest rate is higher. No, the interest rate is higher in the price currency. C is the correct answer.
Sir, A and C are the same thing, no, sir?
No. One is expected demand doesn't mean that interest rate is higher. Forward prices calculation don't exist on expectation. They are on what is the interest rate today, what is the prices today. They don't go for expectation. It is the speculation that goes for expectation. Yeah.
Okay.
So forward futures, they are never on expectation. They are on actual data. Yes. Question number 7.
The Japanese yen per Australian dollar spot exchange rate is 82.42. Japanese yen interest rate is 0.15%. Australian dollar interest rate is 4.95%. If
Hmm.
interest rates are quoted on the basis of 360-day year, 90-day forward points would be closest to. So then, this
90-day forward point. So first of all, we need to take the differential.
yes, sir.
Yeah.
So we need not take the differential now. So like the earlier way we did no. So
Okay.
1 plus 0.15 into 90
0.25.
by 360 is
Yes,
0.25.
90 by 360. Yes. So I will do this 1 plus which one is the which one do you want to put? Japanese yen or doesn't matter because one will be down. Australian dollar will be weaker. So the answer has to be okay. So 1.15. Okay, 1.0%. No. So point zero. Oh, sorry, let me put it 0.0015 times 1 by 4 or 0.25. 0.25 whole divided by 1 plus 0.0495 times 0.25. How much do you get this value?
So 0.9881.
0.988, which is equal to
0.9881.
0.881. Okay. So you will multiply this by 82.42 and exchange rate is this much, no? And then we will deduct from this and multiply by 10,000. So what would be the exchange rate? So forward rate would be F is equal to 0.9881 times 82.42. 82.42. So how much is this?
81.443.
81.4443.
3.
Okay,
But,
443.
81, not 0.81.
Yeah, 81.443. Okay, so we will deduct this, and so hence the difference. Difference. Okay, sorry. Difference or depreciation. Difference means depreciation. Depreciation of Australian dollar. Okay, AUD is equal to
97.7.
how much?
0.977.
0.977.
Yes, sir.
Okay, and this times minus. So it is depreciation means it is minus. Okay, minus 0.977. And since it was percentage, so we will multiply only by 100 because it was percentage. So since it is 0.997, this one is percentage, no, 0.997%. Hence, hence,
Oh,
it
sir,
is,
since all the others are expressed as percent.
yeah. So in
Okay.
the point, it will be 0.977. This
Okay.
one will, yeah. Hence, HNCE. Hence, HNCE. Hence, point is equal to minus, sorry, yeah, minus 0.977 times, it is percentage. So times 10,000 is the one that we do, times 10,000 and divided by 100 because it is in percent. So which is equal to minus 0.97.7. So B is the correct answer.
Yes, sir.
Okay, so let's match. A, and then A, C, B, C, A, C, B, C, B, C, B, A, C, B, C, B, C, B, A, C, B, B, C, 4 is wrong, B, C, B, C, B. Okay, so only 4 is wrong. What is the problem with 4? Before getting the answer, let's correct ourselves. 4 is A. But how? Let's see. 4 is A. look like book is wrong. So the answer is A, but why? Let me see. Will it be A, but why? And the book answer is A. So a 3-month forward exchange rate is Canadian by US dollar is listed by a dealer at 1.012. The dealer also quotes 3-month forward points as a percentage at 6.8%. The 3-month forward points as a 6.8 plus. It has deducted. The CAD spot rate is closest to. Means it has simply deducted this. But it is positive. Why
Oh, sir,
deducting?
so forward minus spot is equal to forward points, sir. So they're asking a spot. So forward minus forward points is equal to the spot rate.
Okay, so no, but why deduct it or why not?
Sir, I'm just telling from the basic formula. So the basic formula is forward minus spot is equal to the forward points.
Forward minus spot. Okay, so F minus S is equal to
forward points.
Is equal to forward points. So okay, is equal to forward points.
Here we have to find S, so we'll have to subtract F minus FP.
Okay.
You just rearrange the formula.
Okay. So you are saying that, okay, so this one was actually not needed. Then F minus S is equal to forward point. That's correct. But here is already 3-month forward exchange rate. So S is F minus this. Okay. So S is equal to F minus this. Agreed with the book. Let's see. But let me read what does the book tell.
Sir, my question is how you are converting it, sir, because it should be divided by 10,000 or...
No, it is percentage, so no need to divide it. Here it is, okay. Given the forward rate and forward point as a percentage, the unknown, because it is already in percentage, if then you don't need to convert into point. It is telling us it has been converted into percentage.
Oh, okay.
Yeah. So given the forward rate and forward points as a percentage, the unknown in the calculator is the spot rate. The calculation is a spot rate times 1 plus forward point as a percentage is forward rate. Very good. Actually, it was given forward rate. I had thought that this 1.0123 was a spot rate. That was my problem. So spot rate times 1.068 is equal to 1.08. My mistake. I had understood that as a spot rate. I had understood this 1.013 as a spot rate. So maybe got more tired. Anyway, agree with the book. So let me first stop this. Did I stop recording?